Yeah, I think let's start. Shankar will join later. Hi, Ankit. Ankit, can you hear me? Manas, can you hear me?
Yeah, Peter.
Yeah. Hi, everyone. Good evening. Every week we are doing F&O Pe Charcha. That is Friday, 6 p.m. Today also we are with Mr. Ankit, and the topic is options trading in turbulent market. So Ankit is well-known person. Everyone knows Ankit. He's a like option trader. He's a full-time trader, and he's a as a engineer by qualification. So let's start with the discussion. Uh, Ankit, how did you start your trading journey? Can you please explain us and motivate us with your journey, how you started, and what all the like market ups and downs you have seen?
Yeah, first of all, good evening, everyone, and I welcome all the listeners to the Paytm, this space hosted by Paytm Money. So, my trading journey started from 2006 when I was still pursuing engineering from a NCR college here in Faridabad. So, my interest grew up. While I grew up, my interest was very much into stocks and what's what news or events uh, move stocks and index. So I was very much into stocks since 2006. But I've been doing full time trading since 2009-10. So have been witnessing markets for the last 16 years and doing full time F&O trading for the last 12 years. So by uh, qualification, I'm an engineer, but after doing engineering, I cleared NCFM exams. So there are five levels. So I'm an CMP level five. So I just wanted to, because those exams are related to basic knowledge about various uh, things that are related to markets like F&O, debt, commodities. So I just wanted to have a uh, knowledge about some knowledge, at least some knowledge about basic knowledge about everything. Then I entered into markets doing full time trading. So that's my journey.
That's amazing, Ankit. But it's very, as an engineer, what do you find more interesting? I mean, your studies in engineering or the market? Like, did you join the market out of
Voice
passion?
is
Or
cracking.
as an engineer, you said you're an engineer, Ankit. So
Yeah,
you joined the market
yeah.
out of passion, or it's just out you are trying to do something, or suddenly you discover trading is a good avenue of earning. So how did you start it? Actually trading. How did you start trading?
So my father used to do not trading but some investments. So every now and then, every in some months, a dividend used to come in paper format. There was a notification that so and so dividend is credit to your account, or there was a check. So that used to really uh, I was very inquisitive about how this happens, that a dividend is coming to you just by investing. So my father taught me the basics and all. So from there the journey started. Then I started reading newspapers. So then the all of interest, and as you say in India कि पहले लोग इंजीनियर बनते हैं फिर सोचते हैं क्या करना है. So the same thing happened to me. So first I enrolled for engineering, then I realized that I don't want to do it.
Okay. So if you have to ask, uh, how do you define that if the market has turbulent times or market is flat? How do you decide on that?
So the best thing, the best instrument which can tell you is India VIX. If you all know, if you are trade in the markets, you must be knowing India VIX. So that is a very good indicator of, because you must be knowing that news is there, but some news are not that much, uh, it does not affect markets that much. So till that spike uh, comes in India VIX, so market is supposedly flat. So if you see India VIX normal trading uh, is between 11 to 14. So this range, if it is moving, then markets are flat or trending, or there is no turbulence, like there is a trending phase. So upside trending or consolidating. But whenever this news comes, so if you look at India VIX, so this news of Russia and Ukraine crisis that was about to happen, but India VIX started to show that something is going to happen, or turbulence is coming ahead. So this, if you look at the chart of India VIX, I'll tell you the exact date. Those who are in front of chart can also uh, look at this. So India VIX started its upside journey from the date of, I think, 24th Jan was the first spike. But this Russia news, then it fell. Then again there was a spike on 14th Feb. So these spikes tell you that something is going to happen. Then it topped out around 24th Feb. So India VIX is a very good indicator to tell you that markets are entering into the turbulent phase, or they are flat. In times of when COVID-19 striked. So in February 24th, February 2020, it started to spike, and then it went from 16 to 80. So India VIX is a very good indicator if you want to know that turbulence is there in the market or not.
Okay. So Ankit, I had a question. Like, since you're saying India VIX is a very good
Right.
indicator,
Yeah.
so like when it crosses any certain level and you find it turbulent, the market to be turbulent. So what all like kind of strategies do you deploy depending on the indicator of turbulence? Like, can you explain some of the strategies? Like, do you buy or sell any spreads or any other strategies?
See, whenever India VIX is in a range, let's suppose 15 to 20, you can, if you look at the daily chart, you would be able to very much tell. It's simple. No charting skills are needed, so you will be able to tell that markets are range bound, and there is no um, turbulence. So if India VIX starts to spike, obviously your neutral, like short straddles or short strangles, you should not do that, because when it starts to spike or start giving range expansion breakouts on the chart, so markets are likely to uh, fall. In most of the cases, markets fall when the India VIX rise. There are very rare cases when India VIX is also rising, and markets are also rising. So it happens. It has happened in 2012. So it comes in 2 to 3 years when India VIX also rise, and the markets also rise. But generally, in most of the cases, when India VIX rises, market falls. So you should not do uh, non-directional strategies. So like straddle and strangle. So those you should avoid, and you should stay with the trend. If the trend is down, you can do uh, spreads, debit spreads also, but in the direction of, like bear put spread, you can do um in the direction of the move. So those
Okay.
strategies you can do.
So like among the debit and credit spread, like in the bearish mode, so which one would be preferred? Like if when there is a high VIX. So like
So bear put spread is a nice strategy. So let's suppose right now market is at 16,700. On today market closed at 16,700. Okay, and you are placing your bet for a bearish move. Okay, so you can buy 16,500 put and simultaneously sell 16,000 put. So obviously this is a debit spread, but you have a limited profit, but limited risk as well. And if the market goes down, you will like most likely to make money.
Yes, that was nice explanation. So some people maybe may not know about the debit spread and credit spread. So Ankit, can you please give a small example like for
Yeah,
debit spread? What is
so
debit spread? What is credit spread? Yeah.
I can tell you the current example, current, if you look at the option uh, graph, so 16,500 put is at around, let me check. Yeah, it's at for this weekly expiry, it is at 177 rupees, and 16,000 put is at 60 rupees. So basically, you are buying a 16. Obviously, your view should be bearish to do this. So you are buying a 16,500 put for 177 rupees and selling a 16,000 put for 60 rupees. So net debit means the premium you have to pay. So you bought 16,500 put means 177 bucks you have paid, and you received 60 bucks in return by shopping the 16,000 put. So this is 117 rupees debit spread. So you have to pay 117 rupees to do this strategy, and the maximum profit it can give you at six if it expires at 16,000. So if it expires at 16,000, you would stand to gain around 323 points. So maximum difference between 16,500 put and 16,000 put should be 500 rupees if it breaks if it close expires at 16,000. So you stand to gain around 500 minus the debit spread, the amount you have paid to do this strategy, which was 117. So I think 383 rupees would be the maximum profit, and the maximum loss you can incur in this strategy is 117, the amount you pay. So that's what you call a debit spread, when you pay from your pocket to do a strategy. And for a reverse of this is, if you suppose you are bullish, if you are bullish, you can do bull put spread. In that, you can sell the 16,500 put and buy the 16,000 put to hedge it. So if you sell the 16,500 put, suppose you are bullish, so you are selling the put at the money, or just out of the money put 16,500, you are getting 177 rupees, you are receiving 177 rupees. And to hedge that, you are suppose you go wrong, so you are buying 16,000 put, so you have to pay 60 bucks in that. The net premium received is again 117. Here you are receiving 117, and you want market to stay above 16,500 to gain that much amount. But here you will get 117 rupees, the premium you have already received, and but you stand to lose uh, uh, 3 383 bucks if it goes beyond 16,000, if Nifty falls below 16,000. So the difference between debit spread is you have to pay money, but the reward is much higher than the amount paid. And credit spread, uh, you receive money, you receive the premium, but uh, the loss that can happen is higher than what you receive.
Right, Ankit. So Ankit, you were saying like in the high week scenario,
Yeah.
we have to do the debit spread is better, and low week scenario we can go for the credit spread, right?
Yes, in debit
Yeah.
spread, if your direction is also right, you stand to gain a good amount of profit.
Yeah. So if the some people may do some neutral strategies like straddle and strangle. So what
Yeah.
is your view on that?
So straddle and strangle, there is no problem with straddle and strangle. But suppose, I'll give you an example. If you are short, let's suppose market is at 16,500, and you do a straddle of 16,500 ATM strike price call and put, you both sell. So right now that straddle is around 177 is the put, and 309 is the call. So it is not the ATM one. So ATM one is right now the 16,600 one. So right now Nifty is at 16,650. So you can do the 16,600 one, which is 209 and 252. So total amount of money that uh, you have received is around 450 bucks. So suppose there is a news uh, over the weekend, uh, a positive news or a negative news, and markets move more than 300, 400 points in any direction. So you stand to lose. So in a high VIX scenario, short, strangle, or straddle are not advisable. Uh, so if you want to do a non-directional strategy, so you can do a iron condor. So that is more because in a short straddle strangle there is unlimited risk, and you stand to gain only 450 bucks if you calculate the theta and reduction in IVs. But the risk is unlimited. You yourself know that in this times of in this times where news flow is coming uh, every hour, or in a few hours, sometimes there is a positive news or a negative news, and markets react so much. So obviously 450 is very 450 premium is very mouth watering. But in these times, if you are non-directional trader, F&O trader, so you need to protect your capital first. The In these times, the preservation of capital is must. You should not lose the capital. So iron condor strategy, where you uh, sell, or butterfly you can say, so where you sell the ATM puts in butterfly, okay, and also buy the hedges. So sell 16,500 puts, call and put, and buy 17,000 call and 16,000 put, so that you are at least safe if there is a big gap up or gap down. So
Right.
this strategy, iron condor or butterfly, uh, should be done instead of short straddle or short strangle.
Yeah,
That would be my advice.
yeah, means for option buyers, they can go for a debit spread. It's better in this kind of high week scenario. And option sellers, they can go with the instead of doing straddle or strangle, they can do the strangle in the both the side, that is the put side and call side, maybe deep out of the money, and that is called as iron condor, right? Yeah, they can go for a iron condor strategy, right? Great.
So, I had one. So, to summarize, we can say like if we expect a bigger, higher move on any direction, then debit spread is a better strategy. And like if you
Your
expect a
voice is cracking. Can you?
yeah, so like the if the trader's view is that the uh, upside or downside in whichever direction is more, then the debit spread is better. And like if his view is the direct downside is less, then the credit spread would be better because there is a cap on the profit, right, in the credit spread.
Yeah, there
So
is a cap on the profit on credit spread. Yes, on debit spread also there is a cap on profit, but
but the movement is higher there. Like in the credit spread, we only collect the premiums.
yeah, but in the high, yes, but in the high VIX scenario, if you get your direction right, suppose right
Mhm.
now you buy 16,500 put and simultaneously sell the 16,000 put, and you get your direction right. So you stand to gain, you pay only 117 rupees, okay, of this debit spread, and you stand to gain almost 3x of what that. And these moves are possible in higher VIX scenario, where you need to get your direction right. You need to mix some of your technicals. So in debit spread, there's a lot of money to be made.
Okay,
When it
got it.
comes to like we're talking about the spreads, but then like we can understand how the volatility is going to increase by looking at, let's say, VIX. But in terms of IV, which strikes to ideally choose? Can you help us with the IV?
Yeah, so implied volatility, for those who don't know, is like uh, the volatility IVs are like it's 23% if you see, 25%. If you look at any strike price, first of all, IVs of puts are always higher than the IVs of calls. That's a known fact, because normally if you want to hedge your portfolio, so you go and first and buy a put. So always premiums due to IVs uh, uh, are always higher in puts. So if you look at when there are higher IVs, and if you can you repeat the question, Shankar?
See, by observing the IVs, like you said,
Yeah,
higher IVs, by
yeah,
observing the IVs, we
yeah.
can also expect that there are turbulent times ahead. So even if
Yes,
the
yes,
markets are flat, but the
yes,
IV is increasing, so
yes,
that also should indicate that that there are turbulent times ahead. So can
yes,
you,
yes.
like you gave us the range in VIX, can you give us the range in IV as well?
No, there is no range in IV. There's a range in India VIX. So because
Yes.
IVs can go high from 20, right now 20, it went till high as 70, 80 in March 2020, when COVID-19 was there and
Yes.
there was
Yeah,
lockdown.
that time VIX was also as high as 70.
VIX
It
was also
crossed
at,
70,
VIX
yeah.
went, I think, till
80 plus.
80, 80 plus, yes.
80
In
plus. 80
last
plus.
time it went above 80 was in 2008.
And that time we did not have properly to measure. But this time
Yeah,
it went up as high as 86 point something.
80. Yeah, 85 or 86, yes. So in such high IV scenario, because that much can be the movement of option price, and you should not do any strategy which has unlimited risk. First of all, if any strategy, because if you know, in March 2020 there was two circuits, I think, down. Second was
Yes,
about to hit.
yes, yes, yes. Two
So
circuits.
two circuits down. So if you would have done a short strangle or a simple put, short put, if you would have shorted puts, naked puts, and went home, then only 1 day is required to totally destroy our portfolio or money. So that's why, first of all, in these high IV scenario, don't do unlimited risk, because every option strategy, you can tell this strategy has a limited risk or unlimited risk. So don't do strategies which have unlimited risk.
Right now, according to you, do you think the IVs are high right now?
No, IVs are high. IVs also are relative. So right now they are less than what they were at 15,600. Okay, but for a general range of IVs, which is around 15-20, that it is higher.
That was my
So
question. I wanted to
yeah,
know the range. At the money range. IVs at the money. So that was around 15 to 20 is the range. Okay.
yeah, yeah,
Okay. So if the IVs basically increase
yeah.
and the VIX also increase, it's better to stay with hedge strategy.
Stay with head strategy, yes.
Hedge strategy.
Or
And like
simply what you can do is, if you are bearish and you don't know any of these strategy, you can buy a put. At least you know that you have a limited risk and you can lose this only amount of money which you have paid to buy the put.
right, right.
Yeah.
So, apart from IV, like how can other things like premiums can help us in identifying the like turbulence? Do like since IVs and premiums are related, so like are the is the turbulent behavior explained in the premiums also? And how do they like how can a trader use that fact the premiums to
So the
uh,
premium has as you all know, the premium has a simple formula. It's a theoretical formula which depends on the rate of interest, number of days to expiry, and all. But if premium should be seen, like if suppose today, let's suppose Reliance is at 2300. I'm talking about taking the example of stock. So suppose Reliance is 2300 and its future is trading at 2310, and today there are open interest has built up in Reliance, and the stock has gone down. So if OI goes up and stock goes down, and the premium also goes down, that clearly means short positions have been built up. So the premium you can obviously premium slowly goes to zero as the spot as is equal to futures on the day of expiry. But if there is a sudden drop in premiums, so you can very well tell that short positions have built up and the stock has also fallen with a rise in open interest. So all of these premiums, open interest thing are correlated.
Right. So you're talking about the open interest.
Yeah.
Can you give some advice on how we can read open interest? Sometimes we say like right, the certain strike price, the lot of open interest, then the lot of sellers are there. For the call side, it can be like seen as a resistance level, and put side it can be seen as a support level. Can you give how you read the open interest?
I think Ankit is having some technical issues. Let him connect back.
Okay, fine. We'll wait. Yeah, users all the listeners, he has very well explained like for high VIX scenario, what we need to do. Like for if you're an option buyer, then do for a debit spread, like buy the option at the money or near the money and sell an option out of the money. So you will get some credit, and some inflow. So your risk will be less. And if you're an option seller, then you can go for a iron counter. Yeah, Ankit is back, I think. Hi, Ankit.
Yeah, sorry, I got disconnected.
Yeah, okay, no problem.
Yeah.
Yeah. So I was asking for the question
Yeah,
on the
open
open
interest
interest.
and change in OI you are talking about.
Yeah,
Which
yeah,
open
yeah,
interest?
right.
Yeah. So open interest is basically the number of open positions in that strike price. So more the open interest on the call side means it's a resistance zone. So right now, if you see the weekly expiry of Nifty, 17,000 has the highest open interest. So on technically also and derivative wise, 16,800 to 17,000 is a tough zone to cross. So if that is crossed, you can expect more upside. Same thing on the downside, 16,000 put has the highest open interest. So that is considered as a support. So change in OI and OI. So first you will have to look at, if you're looking at the option chain or the option graph, you have to look at what two strike prices, one of call and one of put, has the highest open interest. So coming back to Nifty, right now it is at 17,000 and 17,500, but that is too far. So if we look at the current scenario, 17,000 has the highest open interest, which is I think 20 times higher than the put open interest at the same strike price. And 16,000 put has the highest open interest. So this seems to be the range as of now for the current weekly expiry. But if you see change in OI, so suppose the OI at the 16,500 put starts to build up. It has started building up today also. But suppose on Monday it starts to build up. Then you can assume that put writers which were there at 16,000 are now this put open interest at 16,000 is shifting to 16,500. So the support which was earlier at 16,000 gets shifted to 16,500. Then you can assume that it is a sign of more bullishness. On the contrary, if right now 17,000 is the highest open interest, this open interest, the change in OI starts building up at 16,800 or 700. Right now, like yesterday market went till 16,750. So let's assume that that is a swing high also, or a technical resistance as well. Then the open interest will start shifting from, it will start reducing at 17,000 and uh, starts building up at 16,800. If that happens, then you can assume that call writers are shifting their position downward. That is a bearish sign. So change in OI and OI both are important, and you have to max OI. You have to look, and where the OI shift is taking place. And suppose 17,000, you many people don't know, the option writer has the more advantage, because he is paying full margin to get that premium. So suppose 70 rupees is the option price of 17,000 call. A buyer is only paying 70 rupees into the number of lots what he's buying, but an option writer is paying the full margin of one lot or two lot or three lot, whatever the quantity is. So always option writers are more powerful. So if the market has to uh, move considerably, then looking at the current scenario, 17,000 needs to be crossed. If 17,000 is crossed by even 20-30 points, the 17,000 call writers uh, will be very fearful. Like, what if Nifty goes to 17,200, 300? So then lot many things, VWAP comes into picture. But the call writers, if they are sitting comfortably, so that means that is a resistance, and only if that resistance is crossed, then only the call writers run away, and that short covering happens, and that takes Nifty to again much higher levels. The same thing happened in last 2 to 3 days back, when the highest open interest was at 16,000 call, and as soon as Nifty opened gap up and continued to move up, those call writers went away. So that's how the shifting of open interest also takes place, and it is clearly visible in change in OI and the maximum OI.
Right. So, so is it more profitable in volatile times like these? Is it more profitable using calls and sorry,
More prof-
yeah, is it more profitable for buying options or selling options? What is more profitable?
sir,
Of course, we
sir,
have to use hedging.
buying option is always more profitable, because if you are selling an option, you are getting limited profit and a possibility of unlimited loss. But if you are simply buying options, then the profit is unlimited, and the chances of loss is the premium that you have paid only. So always buying options has been more profitable, at least for me.
Now, when it comes to turbulent times like these,
Yeah,
where
yeah,
we are assuming the sellers have already considered the risk involved
yeah.
and then set the premium up. And now, let's say, for example, they started writing 17,000 call. It's quite possible they can write that.
Sir,
So when the premium is
voice is,
where the premium is high,
yeah,
am I audible now?
yeah, it's cracking in between voice.
Okay. So let's assume the
Yeah,
sellers are now, because the premiums are high,
yeah.
won't it be profitable if we start writing?
Sir, but in writing, if you are doing naked writing without any hedge, so if you are not doing spreads, only writing puts, so you are at risk of incurring unlimited loss as well. Na? Suppose in 2 3 days
No,
back,
no, no, no. We will be writing writing puts, but also hedging it by buying.
yeah. So you are not
Of
only
course.
writing it, then that is
Not
a,
naked, not naked.
yeah, not naked. Then there are more chances, because if IVs go down, okay. So suppose you are bullish right now, and you have sold a 16,500 put and bought a 16,000 put. So if you are doing credit spread, so there are more chances, but your direction, like, at least your it should stay above 16,500 to make you profitable. But still, I would believe, if you get some of your direction right, you can double triple your money uh, in a debit spread or even buying a put. Okay, क्योंकि if you have to have some You cannot go into markets saying you have to have a view. Either you are bullish or bearish, and suppose you go right, then obviously there is great amount of money in buying option than selling option still.
Of course, of course.
So, but theta factor also plays. So, like, should we keep in mind like when what is the good time to buy and sell depending on the time to expiry?
So but
So, as in when we reach to the expiry, then it's a very high chance that buying option will decay a lot, right?
correct, correct, you're right. But in, if you are buying a debit spread, so if there is a debit spread and you are buying, suppose you are bullish and you are doing a bull call spread. So in bull call spread, you buy a 16,700 call and sell 17,000 call. So if the theta obviously will be higher in 16,700 call, but uh, in one strike price you are paying theta, and in other strike price you are getting theta. Not in same uh, premium, but at least there is some uh, less disadvantage. And suppose you get go right, you go right, then you stand to gain a lot of money in comparison to those who are selling options. So if you compare, see, buying options is always more profitable. Only problem is you should get the direction right. And if you are not sure about what would happen, you don't need to do always weekly expiry. If you're not sure what will happen in next week, you can do trades in monthly expiry as well. So suppose your view is Nifty has bottomed out, and you do a bull call spread in a monthly expiry, so you get a lot of time also.
You're right, and this is something
Right,
which
Ankit.
many traders don't do. They looking at the weekly, they
Yeah,
sometimes skip the monthly
yeah.
options.
So you have to make money. Nobody says you have to make money from weekly expiry only. So earlier, I think pre 2018-19, there was no weekly expiry in Nifty, and pre 2017 there was no weekly expiry in Bank Nifty. Still, people used to make money from monthly. So making money is the objective. Making money from weekly expiry is not the objective.
Right. That's true. Ankit, I should have asked this question in the beginning of the session.
Yeah,
So, you're a option buyer or option seller? What you do?
I do many strategies, which
Okay.
are option buying also and option selling also. So there is no
Both you do.
one like rule or formula or something that can make you money in every type of market. So you have to have a view. Suppose my view is right now bullish, and I am getting a option. Suppose let's discuss my view right now. So my view is, as soon as 16,800 is crossed, uh, I expect Nifty to go to 17,200, 300. So if this is my view and 16,800 is crossing intraday, so and I think it can come in next few days, because you can mix some technicals with option as well. So I'll prefer to buy a option. Maybe not this weekly expiry, next weekly expiry, so that the theta impact is less. And suppose
Mhm.
right now I think market will be range bound. Suppose my view is market is range bound. So I don't think it 16,800 is crossed. Will be crossed in this expiry. So I'll sell a 17,000 call. I'll not. I'll simply I'll sell a 17,000 call, and I'll not uh, um, uh, buy a put, because if the theta impact is more.
Mhm.
So it all depends on.
Ankit,
So
yeah, you're saying like you are doing multiple strategies. For
yes,
example, if your view is bullish view, for example, view is bullish on
yeah,
Nifty. Now it's around 16,500 or
yeah,
600. So you are expecting some upside movement.
yeah.
So
So what is my
you can do multiple.
what is my
What
time
all the kind of
expectation
strategies
also
you
that I
do?
have to see now? If my
Yeah, yeah, right,
if
right,
my expectation is like 17,000 will come in next 1 or 2 days only, then I'll simply buy a call.
right. But see, for example, your view is upper side, and maybe you're saying like maybe within a week or two it will go
Yeah,
upside. So short term view is
yeah,
bullish. So what all kind of strategies you do? One is like maybe a buying a
Yeah,
call. Second one is protecting the buying capital by selling a
yeah.
call as a debit trade you're doing.
So
Maybe you know that the target of the the index, so you may sell some. You can do some straddle or something or strangle something, right? What all things you do
so suppose
if
my
your view is bullish?
suppose my view is bullish right now. Okay, just before the close at 3:15 p.m. my view is bullish. I and My view is bullish, but not for this week. I'm talking about my view is bullish, but not to a great extent. So what I'll do is buy a 16,700 call, which is just, you can say, at the money. So I'll buy a 16,700 call, but I think 17,000 is a big resistance. So I'll buy a 16,700 call and simultaneously sell a 17,000 call. But if my view is little bit 2 to 3 weeks time frame, so I'll directly do a monthly. I'll buy a 17,000 call, and there is a risk management system. You can do it in buying option as well. You can keep a stop loss of some moving average or some swing high or some uh, level of your underlying. Suppose right now Nifty is at 16,600, and I am bullish. I am buying a 17,000 call, but my stop loss on underlying is at 16,550, 100 points from here. So as soon as 16,550 breaks, I'll sell that call. So the risk management system, you can apply it on your buying option as well.
Okay.
Right.
So, like you suggested some strategies to enter in these conditions. So, what if like our whichever strategies we enter and they go wrong? So, what are some of the exit mechanisms that we should keep, even if the strategies go right? Like, at what time should we exit? And if it goes wrong, then what type of risk mechanism should we have?
Yeah, good question. Suppose, first of all, you have to have limited risk in these turbulent times I'm talking about. So any strategy you are doing, you can go to many websites. Like I go to Opstra website. There's a strategy builder. You put your strategy. It will tell you how much risk, how much maximum loss you can make. So that has to be limited, first of all. Okay. And there are, like, if you are buying a uh, suppose there are 4 5 strategies are basic in market. Buying a call, so you can keep a stop loss of a swing low of that option price. Okay, suppose I have bought a, 17,000 call at 70 rupees right now, so I can keep a stop loss of 50 rupees, which is a swing low on 15-minute or 30-minute chart of that option price. You can keep a stop loss according to the underlying as well. Suppose I bought a 1,000 strike price call of Cipla today, okay, at 30 rupees, so I can keep a stop loss of 20 rupees. I can keep a moving average as a stop loss. I can keep VWAP as a stop loss. So there are many options. It depends on you. Oh, what is your risk appetite? So you have to see. Everybody don't keep a same risk management stop loss. Some people keep a Donchen channel. Some people keep moving average stop loss. Some people keep swing. So every person has his own risk management strategy. So I keep moving average and VWAP mostly as a stop loss. So you can keep swing low as a stop loss. And for target level, let's suppose my target comes in that underlying. Suppose I'm buying Nifty or a stock. Okay. And like today, I bought a Cipla call at 30 rupees, and my target is at 1,000 strike price of call at 30 rupees, and I kept a stop loss at 20. And suppose my target is 1,080. So as soon as that target comes in the on the underlying, you can book your option. So that could be a uh, uh, booking profit strategy. Or when you one more strategy can be when you bought an option of 100 rupees, okay, in Nifty. As soon as it double, you book half, then you cannot make loss. Or as soon as you book half, you keep the trail your stop loss to cost, so that you don't incur loss. So these are like many people do these mechanical, like I buy an option, as soon as it doubles I book half, and rest is I trail or keep stop loss to cost or keep shifting stop loss upwards. So there are many strategies of booking or doing risk management to like you said, to each its own. So whatever you like, there are many trailing stop loss methods that you can take.
Great, great. So, any final advice, Ankit, you would like to give to all the audience who are listening to us today?
So I am still a learner. So what
And
advice?
especially in these kind of turbulent markets.
So yes, in especially in turbulent markets, my advice would be never do naked short puts. So many people, like, they are very mouth watering. Like right now, a 16,000 put, maybe many people think that markets have already bottomed out, so you can go and short a 16,000 put and sit idle till next Thursday. But in turbulent times, don't never do naked short puts. You might still save yourself from a naked short call, because when there is a good news, markets do open 2-3% up. Like I think on yesterday only market opened up 2 3.
Yesterday only it happened.
Yeah, it will open 2-3% up. You can still make adjustments or whatever people call intraday. So you can still manage your calls, short positions in call. But in short puts, you have already seen two circuits in COVID-19 in March 2020. So you can get killed, you can blow up your account in single day. So my advice would be, they many people do it like just to gain those pennies or 30-40 bucks. They will do short OTM puts. So don't do it. And one more advice would be, any mistake and being adamant on it can take you weeks, months, years behind in market in your trading career. So suppose you are shorting a call, or as markets go up, you keep on shorting next, or you keep on averaging. So don't do that. Markets are supreme. You are not. So respect markets and don't be adamant and keep uh, averaging that mistake. It can move your trading career months, years behind. You can go where you started 5 years back. So option is such that you should don't do adventurism here.
Especially, I tell you, Ankit, when I initially started trading in options,
Yeah,
the first few months, few weeks, rather, when I saw the prices were actually, this is happened 2014, uh, I saw the prices moving down. Huh? I thought, Arey, as an investor, I keep on doing SIP. So let me average it. So every week I used to average and it became zero. So this is how we all actually learn. I mean, the options are not an SIP. This is something which I always tell people. Very true, what you rightfully said. So, Ankit,
yeah,
thanks a lot for your time
yeah,
and
yeah.
sharing with us your insight, your over a decade of experience which you shared with us in this 1 hour. And we are really thankful to you and for guiding us in these turbulent times. For people
Thank you.
who are listening to us, let me tell you, these are just views. These are not views. These are just for whatever Ankit shared and we asked questions. It's only and only for our knowledge purpose. So before trading in any financial instrument, please understand the risk associated with it and take help of an advisor if you want, or undergo training. So we do conduct a lot of trainings through the Wealth Academy as well, and Paytm Wealth Academy. So we have our products which helps you compare one product with others. So there are a lot of things which you can do, but understand the risks associated with the products and invest. And thank you, Peter and Manas, for asking so many lovely questions on behalf of our audience. Audience, you can write to us. You can directly message us. And follow Paytm. You can follow us. Write to us. Ankit. You can write to Ankit. And thanks, Harsh, for organizing and getting us all together in this space. And thank you, you lovely audience who are there with us for all the F&O Pe Charcha. It has been a great learning experience for me, and I'm sure it had been a learning experience for you as well. So thank you everyone for your time and have a great weekend ahead. All the very
Thank you, Ankit.
best.
Thank you, Ankit, so much.
Thank
Thanks.
Thank you,
thank
Ankit,
you.
Shankar, Manas, and all the audience. Thank you very much. We'll connect
Yeah.
next week, Friday, same time. Yeah.
Thank you
Yeah.
everyone. Thank you.
Thank you, everyone.
Absolutely. Absolutely.
Thank